Hey, good morning, everyone. Welcome to the new week. This is Monday, March the 23rd, 2026. This is the macro snapshot. Okay, let's immediately just have a look and see what's going on. I just want to start off with the Bloomberg function, the WIRP, just to see the sort of extraordinary repricing of the Fed and all central banks around the world. And so what we can now see is that going further out into the year, if we go out, let's say, to the December meeting, we now have sort of 18 basis points of sort of hikes priced in. So a three-quarters of a chance possibility of a hike priced in. And then if we go actually out to what's interesting is that if we then go out to 2027, the market is starting to say that potentially there might be sort of some kind of cut. And so what's interesting is that the market is now saying that, within maybe the next 4 or 5, 6 months, the percentage, the possibility of a hike, not just a hold, certainly no cuts. So as you can see here, suddenly there's absolutely no cuts priced in for 2026. And we don't have a full hike priced in. We have about three-quarters of a possibility. So about, 19 or 20 basis points out of 25 basis points priced in by sort of September, October. But then the market is basically saying, so what it seems to be saying is that, first of all, the Fed absolutely will not be cutting at all. So we remember just to sort of, before the war, a month or two ago, we were talking, about 2 or 3 cuts. The talk was that, sort of Kevin Warsh would be coming in May. He would be Trump's puppet. He'd be cutting immediately, maybe even 50 basis points. But now we're in a very different scenario where the market's essentially saying not only will there be no cuts, there may actually be a hike at some point. But then, interestingly, the market is saying that further on in 2027, so let's say maybe 12 months away from now, there's sort of extremely high sort of inflation caused by the energy spike might be actually causing a sort of a growth destruction. We might even be getting to some kind of sort of economic slowdown, even a recession. And if we have a look and just look at the just how much this has changed. This is for the December meeting for the Fed, and you can see here that the current sort of target rate, as we all know, is between 350 and 375. So we have a Fed funds rate currently at 3.64. And what's extraordinary is that if we do a comparison, so let's just do a comparison and go 1 month ago, so pre-war, we can see that 1 month ago, which is this very pale blue, you can see that the possibility of staying on hold was just 4.53%. So only 4.53% of sort of in terms of positioning was saying we're going to get a hold. And in fact, the market was much more sort of positioned at that point for cuts. But now what we can see is that over the last month or so, we're now even pricing into the right-hand side. So there's a right-hand tail risk of hikes. And you can see here that from a month ago, there was almost nothing saying we'd get a sort of a hike. There's literally nothing at all until now we have a 40% chance of one hike and even a 17% chance of 2 hikes, which, as you can see here, literally there was nothing priced in a month ago. So a huge sort of realignment. And we can see this if we start just looking, even overnight, we had some very significant price action. So let's now look at a few different markets here and see what's going on. First of all, I want to talk about volatility. So you can see here that the VIX, this is sort of the pre-market here up at about 30. So very, very elevated VIX. And essentially what's happening is that the market is now being priced in for sort of binary sort of situation. So either a rapid and massive escalation or a de-escalation. And a lot of this has been caused by just the incredible volatility coming out of Trump. And you'll remember that about half an hour, 45 minutes after the close of the futures on Friday afternoon at about 5:30 or so, Trump came out with his tweet, which we probably all saw, essentially saying that thinking about winding down, pretty soon, our 4 or 5 objectives have been met. The degradation of their missile capacity, and their nuclear capacity in Iran, et cetera, et cetera. And so Trump at that point seemed to be essentially saying, hey, this is a bit of a taco. We're going to be sort of winding down with, a unilateral cessation of hostilities. We've achieved our sort of goals and whatnot. And what we saw is that in the post-market, we saw that the SPY sort of trading the post-market ripped higher. There was a rip into the close. So, the market seemed to really like that. But then what we got on Saturday night at about 7:44 p.m. at 1944 was another Trump tweet, which essentially seems to sort of massively raise the stakes by essentially saying that unless the Strait of Hormuz was completely opened by the Iranians, that there would be within 48 hours. Now, keep in mind, 48 hours is 7:44 p.m. Monday night. So today, 7:44 p.m. Trump said that the Americans would obliterate all of the power stations in Iran, and of course, Iran has come back and said, "Well, hey, if you do that, we will, take out all of the not only the sort of energy facilities and production and refining facilities in the whole Gulf area." So presumably, Qatar, maybe the Saudi Arabia, et cetera, but potentially even attacking sort of other energy plants and desalination, which is the necessity for water. So we now have ourselves in a situation where Trump has gone from Friday afternoon saying that, hey, they don't even care about the Strait of Hormuz. This is the rest of the world problem because the US doesn't need that oil, which of course is a very naive and simplistic attitude until, sort of literally 24 hours. So you have to say at this point that the Trump administration seems to be, how can I say, sort of raising the stakes and becoming, I would say, a little bit desperate. We even have now sort of Besant coming out over the weekend, Secretary of the Treasury. So not the Foreign Minister or the Secretary of State, not the Secretary of War, but the Treasury Secretary who's in charge at the White House, coming out and essentially saying that maybe 50 days of elevated war would lead to 50 years of Iran not having a nuclear weaponry and whatnot. So the rhetorical sort of stakes are being raised. And so the market now is at the situation where there's a lot of binary outcomes. So what we're seeing is that straddles are exploding in cost. We saw the VIX is almost up to 30, so implied volatility very, very high. And that's just because it now seems that we're sort of in this binary world that we either could get a very, very serious escalation. Who knows tonight what might happen, or maybe a complete de-escalation where suddenly, the US declares unilaterally that the war is over. Now, of course, does it take two to tackle? We shall see what Iran's response would be. But so that's the situation. And all of this, of course, is just meaning that if we just go to some of these primary markets, and I just want to go to the US yields, which we were talking about before, and let's just look at the 2-year yield. And you can see here that this is ripping higher now. It's now at above 4%. And you can see that even sort of overnight, so from 6 p.m. last night on the futures open, you can see that the yields at the front end are ripping higher and now above the key psychological level of 4%. Now, keep in mind that the Fed funds rate, the effective Fed funds rate is 3.64. So what is that telling us? That's as we've been seeing from the charts I showed you at the beginning of the video, the market is now pricing in the possibility of hikes or a hike by the end of the year. And when you have the 2-year yield above the effective Fed funds rate, which is relatively unusual, well, at least what it's signaling is to say that, hey, the future direction for the Fed should be upwards, not flat, not holding, and certainly not down. So we're getting to, quite interesting territory here. And it's the same thing if we look at the 5-year yield, not quite as explosive, but also the 10-year now at 4.43. And you can see the 30-year getting pretty close to this key level of 5%. Now, the other interesting thing, of course, is just looking, why is this? Just because inflation expectations are going up. So if we look at something like the break-evens, and I've got here, it's not perfect, but I've got just here on TradingView, I've got here the break-even. So if you look here at the 10-year break-even, you can see that since the war started, that's gone up from about 2.26 up about 12 or 15 basis points. And if we actually look at, I think we could put in the break-even. Yeah, if what I'm trying to say, I don't have the 2-year, but it's been most explosive at the front end. Let's say the 2-year break evens, and the 1-year break even has actually gone up about 2%. You see that a little bit here with the 5-year, which has also gone up a lot. So the point is that inflation expectations, especially the 1 and the 2-year, I don't have the chart here, but the 1 and the 2-year inflation break-evens are ripping much higher. So the market is freaking out and thinking that all of this sort of higher energy costs, but also food costs, is going to essentially demand that the central banks like the ECB, the Fed, the BOE, they might have to hike. And the Fed is not even the most affected here. The most affected is actually the Bank of England, where the market has very aggressively repriced in a hawkish fashion, and also over in the ECB. So if we go to the Ster market and we look at the Euribors, you can see here the implied yield of, let's say, December 2026 just continues. It's basically going parabolic at this point. You can see here this vertical gray line is when the market, when the war started. And you can see that since then, we had essentially a 2%. And you remember the rhetoric of the ECB was we're in a good space, or 2%. We don't need to hike. We don't need to cut. Nice economic growth. Inflation's come down to target. But what we can see is that since then, and again, this is continuing unabated, the market has repriced almost 1%. So the market is now pricing fairly, it's quite extraordinary. An extra percent of hikes have been priced in. So that's 4 hikes have been priced in, basically, by the end of this year. So this is a December 2026 contract in the Euribor, which is the short-term interest rates. Similar situation in the Fed. But the point I'm trying to make here is that in a certain sense, the US is sort of the least of the global worries because this is exploding, especially in Europe, which is considered to be much more exposed to higher energy prices. So let's just go looking at the market. So we're getting yields ripping higher, especially at the front end. It's causing a huge flattener. Now, what's that happening? Now, is the market massively moving? And what we saw overnight is that the market initially sort of gapped, it opened and gapped lower, then went up a little bit, but couldn't sustain that in any shape or form. And we're seeing that global equity, so including the US, but actually even more so in East Asia and in Europe. So one of the issues, or one of the themes which is emerging here, is that the US in general is a little bit more sort of isolated because it's less directly affected by the energy, although it is affected. Also that its stock market is less directly affected and its growth. But the question is, how long will that maintain? And you can see that essentially is very, very heavy price action. If we just throw in a few EMAs here, we are well below the 200-day EMA. That's absolutely sort of cracked. And at this point, you've got to say, just the technical damage. There's been a lot of technical damage done, and it looks as though, excuse me, the ES futures wants to head down to maybe 6,400, something like that. And then if it breaches there, you're talking maybe 6,100, something like that. And if we look on the SPX, just the cash index, which a lot of the institutions, of course, follow, you can see here that also has breached the 200-day moving average. And the key levels here does seem to be this level here, which is basically 63.50. So that looks as though it wants to retest down there because, in terms of fibs and whatnot, we've kind of blown through a lot of these. Similar kind of situation here on the NASDAQ. If we look at the CAD NASDAQ, the NDX, it did bounce off on Friday, this pretty key level here at about 23,900. But if we look at the futures, you can see that, again, it bounced overnight off this key level of 23,750. So it seems what's happening now is that the US sort of stock indices are probing lower, just pushing lower, testing pain points. And I think as I say, there's going to be some kind of reaction. Who knows? We might get choppy price action today because I think also, much like in the past, we're reaching what we could describe as a state of rhetorical saturation, by which I mean that Trump's increasingly how could I say, extreme tweets of sort of total annihilation or capitulation or de-escalation or massive escalation. The market is a little bit short, certainly here. There's no sort of obvious path, and it's simply becoming a situation where there's going to be binary outcomes. If, for example, Trump does not blow up all the power plants by 7:44 p.m. Tonight, and if the Iranians, there's no escalation, in fact, maybe there's a de-escalation or something like that, who knows? We could have like sort of a massive rip. Hold on, what just happened? Sorry, guys, I just want to look at something. It looks as though suddenly there's been, okay, so this is, oh my God, okay, there's obviously a headline that's just come through. This is a 3-minute chart. So I'm doing this at 7:06. You can see literally there's just been a massive, this is what I was saying. Oh, obviously, it's been a crazy headline. What's going on? What's going on? Something is going on. Trump, I'm pleased to report that the United States of America and the country of Iran have had over the last 2 days very good and productive conversations regarding a complete and total resolution of our hostilities. There we go. Based on the tenor and tone of these in-depth, detailed, and constructive conversations, which can the Department to postpone all military strikes for 5-day period. There it is. That's the taco. Guys, I'm going to go to my trading charts here and leave it there. There's the taco. So I'm going to just sign off here, just for the time being, because everything we've been saying is redundant. So let's just see if this is now going to be reversed or not. So I'll leave it there. Have a great and interesting trading day. Thanks very much.